Hello, Michael Bull here with the Commercial Real Estate Show. We're at the 2015 Expo and Conference from the National Association of Realtors. We're here in San Diego. We ran with Todd Kuhlmann. We pulled him into our booth. We're going to talk to him. Todd, you've got this webinar coming up on, I think it's a very important subject that people need to hear about, is how rising interest rates are going to impact commercial real estate and cap rates. It's coming up this Thursday, right? And so give us a little preview. So I think some people are worried that, we're hearing the little bubble talk that maybe people are overpaying at these 3 and 4 cap rates.
Well, these low cap rates, it's all-time low for a lot of these, which also means, low cap rates drive the value. That's how the cap rate is calculated. Not a return on the investment, but the value of the investment. So with these low cap rates, what that basically means is the prices are high, really high right now. Well, these institutional investors can pay high prices for these low cap rates on these investments when their cost of capital is so low. But when their cost of capital starts increasing, then something's got to change and something's got to give. And that's what we're going to talk about Thursday.
Interesting. So, everybody expects interest rates to rise, but it seems like we keep waiting, it hasn't happened. Do you expect that we'll see something in December?
Oh my gosh. Well, first of all, Michael, I've been saying this for a couple of years, but you can go to YouTube and you can Google, or you put in YouTube, search for my name, credit crash. So Todd Kuhlmann credit crash, and it pulls up a video that I did in August 2007, talking about the credit crash we were going to have in the marketplace, and that was well over a year before Lehman.
That was a go-go year, too.
That was a go-go year. It was one of the best years we had. I had some of my best friends, real estate brokers, coming to me and saying, Todd, why are you being Debbie Downer for this? And so I'm seeing some trends going here that I saw back then when I did that video. And so I don't think it's about necessarily when, but it's not necessarily if it's going to happen, but when it's going to happen is definitely the situation. The Fed's meeting again, and we're going to see. Wall Street was not happy last time when they didn't raise interest rates, which I thought was very interesting because of some world dynamics. And obviously now, unfortunately, we have many more world dynamics with what's going on in Paris and things like that. So it's going to be interesting to see what the Feds do this coming week on the interest rates. But we know what's going to happen. It's the million-dollar question is when.
Right. And it's interesting to come from you because, in case you don't know, listeners and viewers, he teaches CCRM classes 101, 104. You're looking at the math, you're looking at these numbers, you're looking at the return on investments all the time, and you like you said, you kind of told us in 07 what was coming, and even myself, like, nah, it's residential, it's not commercial, it's not going to happen, but it did. So give me an example of how the value might adjust. Let's say it is 2 years from now, and interest rates are 200 base, but they're 2 points higher. What's that going to do to a value of a sample property?
Well, let me first back up, because what I feel, especially for a lot of your audience and real estate in general, you can really make money in real estate in an up and a down market as long as you know what to predict. Right. So if you know this is coming, then you can make adjustments for it and come in, sell the property if it's time to sell the property. Just be aware of it. I've talked to some people lately that are going in, they're still buying the properties, but what they're doing is they're using exit cap rates or going out cap rates that are higher than the going in. And if it still makes sense, it still makes sense based on the low cost of capital today. So that's not to say that the industry is just going to halt, but there is going to be an adjustment. So what we're going to see is we're going to start seeing as these interest rates go up, and we're seeing this push on the returns that are required by some of these institutional investors. They have what's called a discount rate, required discount rate. That's our yield requirement. And they have to earn that much money in that investment in order to meet their obligations. Think of a life company. They have to pay out life insurance policy. Think of a pension fund. They got to pay their pensions, right? Well, if their cost of capital goes up and their required return remains the same, then what's got to change? What they can pay for the property is what's going to change. Right.
So exit cap rate's a good thing you brought up there. So I know I was in this situation back in 05 and 06, when I'm representing a buyer and I'm like trying to tell them what exit cap rate. I knew it was going to be higher, but I didn't know how much. How do you get...
that's the biggest variable. Yeah. So when you're doing commercial real estate projections, the number one variable in the entire projection is going to be what you're going to sell it for when.
Right.
And so that's what we're going to talk about Thursdays. We're going to go into a lot of detail on how to look at the cap rate, going out cap rate, and what that means. So if you said, okay, well, I got a 200 basis point increase or a 2% increase into that interest rates today, with interest rates being about 2.3% on a 10-year Treasury today, and you look at the 10-year Treasury, this is the indicator, the 10-year Treasury rate. Look at that 10-year Treasury rate, see what it's doing, keep an eye on it, because as it goes up, hey, that's our cost of capital in the commercial real estate world. And so as it goes up, and if it goes up 200 basis points, no longer is it 2.3, but it's 4.3. But guess what? The overall average, and this is going to be interesting for new people in the real estate industry that may not know this, the long-term average yield on the 10-year Treasury rate, and mind you, it's 2.3% now, the long-term average is 6.4.
Wow, yeah. That could be a big change. So a lot of investors are kind of banking when they pay these low cap rates, right? They're banking on improved NOI. So obviously you want to base your decisions on the individual property and its sub-market and that sort of thing. But is that what you hear these investors are saying to you, that we have enough growth that we're going to be okay with even a rising cost of money?
Well, there's a couple factors on this. Number one, we graph out, we looked at what was happening in 2006, 2007, 2008, and right now our values are higher than they were in 2008. So if you chart this out, we went up in 2008, went down dramatically, as we all know, in the credit crash. Now we're back up, but we're past where we were in 2008 on value side of this equation. So if you're asking me, what do I think these values are going to do, where we're going to be at, there's going to be a correction. And I'm going to say it. There's going to be a correction. Now, depending on the market, you mentioned that too. Tertiary markets, NOI adjustments, and we know cap rate is a method of calculating the value based on NOI. So how much more push can we have on the NOI? I live in Austin, Texas. I mean, we've been figuring out every way to suck every dollar out of every property lately. Now, if I go to a tertiary market, a smaller market that may have just hit this cycle, maybe they have some ability to increase this NOI over the next few years, and it's not going to hit them, the interest rate adjustment's not going to hit them as hard as maybe a market that's already adjusted its pricing, and the rent and the rates are as all-time highs as well.
Right.
Because the demand's there. And the demand's still there. So, I'm not going to be this Debbie Downer person that's saying, everything's going to, fall from underneath us, because demand is there.
Yeah.
And I would say, if you really want to be on the fronting edge of this market, compare the demand, what's the demand drivers, to these interest rate indexes. And it's you got to look at all of it to figure out what you can sell that property for in the future and what the return's going to be.
That's good information, Todd. So you're with CRE Tech, so how can people, if they want to check out this webinar, find it?
Yeah, best thing to do, go to cretm.com, cretm.com, or shoot us an email. Shoot us at sales@cretm.com, and we'll sign you up for the webinar.
Todd, thanks a lot.
All right, thanks, Michael.
Michael Boyle with the Commercial Real Estate Show at the 2015 NAR Conference and Expo.
The Commercial Real Estate Show is brought to you by Bull Realty, a great place to do business. RealNex, software for productivity. Xceligent, information for the professionals. And Commercial Search, properties for sale and lease. To access these companies or for additional videos, podcasts, and articles, visit creshow.com.